Good evening, everyone. Thank you very much for being here today. And thank you, Regina, for introducing us. So for those who are joining us for the first time, we are glad to have you. We've been holding a series of seminars from last year. So we have quite a number of videos you can actually watch, but in the recent past, we've been talking about preparing for post-retirement medical. So preparing now so that when you are in retirement, you're able to take care of your medical expenses. And the last two sessions, we were privileged to have an expert in seniors medical cover, Mercy Andaro, and she did a fantastic job of taking us deep into the healthcare insurance for seniors. And she taught us about what we need to look for, what we need to compare among providers, how to make decisions, whether we should have insured in outpatient or we should have a managed fund. And today I'll just be picking up on that conversation. And today I'll be looking at how do we fund those expenses. So we will be looking at why do we really need to prepare for this? And in addition to that, we'll go into the various ways you can prepare for this, because when it comes to investing for future, and it's a long-term future, for many of us, hopefully we are praying for long life. So we are likely to live for another 20, 25 years or even more. That's a whole life stage, a whole developmental stage. So we need to have investments that will take us that long. And they also need to be quite diversified. And I will share an example, and I've borrowed heavily from my clientele. It's not one of my clients' data, but it's a representative of an average client, the kind of assets that they normally have and how you can optimize those assets to ensure that you're able to take care of your healthcare expenses. So without much ado, I will share my screen so that we can go through this together. Feel free to share your questions as we go along so that we'll be able to handle them. So I know we all know this, but it is important just to remind you, why do we need to prepare for medical expenses? Because the truth of the matter is, while most people know that they need to prepare or to ensure that they have funds for retirement, very few people actually do it. So, you know, it's a major concern, but you take care of other things, you take care of a home, you take care of an income, but sort of many people don't set aside money specifically for retirement. But especially for us in this season, it's important to recognize that the life expectancy is increasing. At independence, life expectancy was in the 40s. Now it is in the mid 60s for this country. And as the more we get medical technology, medical advancement, we are likely to live much longer because we're able to diagnose and treat diseases much, much earlier. Yes, in our demographics, we have very few people who are above 60, but we expect that to increase. The other thing is that in as much as the lifespan is increasing, many people are retiring early. We have many organizations, even especially the private companies, there are very few people who have retired, probably with the exception of parastatals, where these organizations are quite old. In the organization I worked for about 12 years before I switched from employment, we witnessed very, very few retirements. Very few people left at 60. Many people leave way before. And the generation that is even behind us, they don't want to work for long. Many of them are saying, I want to retire in my 40s. Even our generation, many people are saying they want to retire early. So we are looking at a longer lifespan, but a retirement that starts way early. In as much as treatment is improving, many people are getting chronic illnesses such as diabetes, hypertension, and other conditions quite early in life. We're having people in their 30s, in their 40s, managing these conditions. And some of them are lifelong, diseases, things you have to manage for the rest of your life. So if you are getting these chronic illnesses early, then it means we'll have a very long time to manage them. Old age, retirement, it's associated with age-related diseases. Even if you've lived a very healthy lifestyle, many people get some age-related diseases. And for majority of us, we will not die in our sleep. many of us will probably get sick, incur some medical expenses before death. But the other thing we realize is that healthcare costs are increasing. And I don't have statistics, but I believe healthcare costs are increasing at a much higher rate than even the inflation rate. The cost of consultation, seeing a doctor, you go this time, it's 1,500. In a few months, it is 2,000, 3,000. If you want to see a specialist, you'll probably pay from 3,000, 4,000, 5,000, or even more. So all these need to make us recognize that this is something that we really, really need to plan for, because if we don't plan for it, then it means that we will shift this burden to someone else. And in most cases, we tend to shift this burden to our children or to our family members. So for us to enjoy a long life like we would all want to, it is important that we prepare. Prepare, but pray that you never get to need this money, because that is what we'd all want to do. So in the last two sessions, we learned that insurance does not cover everything. And I'll just do a very quick recap of some of the things, not in details, but broadly, some of the things that health insurance does not cover. When you buy a medical cover, it does not cover. It does not cover all health checks. Some providers will normally give you an annual checkup, but it will normally be restricted to a certain amount. So if you need more health checks, you'll probably have to do it out of pocket. If you're using doctors and facilities that are not in the panel, sometimes insurance company will not pay. And this is becoming increasingly important. A friend recently told us how their brother was saved. They believe he was saved because he asked for a certain physician, a well-known physician in the country, who was able to relate the current illness to the other parts of his body, and he was rushed to ICU very, very fast, while the other doctors didn't think it was necessary to go to ICU, and he was able to make full recovery. But that consultation was quite expensive. So it's important to recognize that sometimes you might actually need, or even to go abroad for treatment, because the kind of treatment you need is not available here. So your insurance might decide not to pay for that. There are certain prescription drugs which are normally not covered, probably certain what you actually need. There are certain treatments and therapies that are not covered by insurance companies. And this will tend to be probably new experimental treatments that probably could actually save your life. And with illnesses, there are incidentals that are never part of the insurance company. For example, because of your illness, you might need actually to do some modifications to your house. That is not covered in any insurance. You'd have to renovate your house and make sure that it can accommodate your maybe mobility issues. And I think for those who are with us a few months ago, we talked about making your home retirement ready, anticipating that these needs might come. And so you need to ensure that even as you prepare for retirement, one of the things you do is to ensure that if need be, you can actually convert your bedroom into a hospital room, because some people have actually needed that. Transport costs, depending on where you live, because part of the factors that normally will determine how much you'll spend in healthcare in retirement. Of course, the first one will be your health condition, but location, where you choose to retire. Is it Nairobi? Is it out of Nairobi? Wherever it is, the health costs are also very dependent on location. So depending on where you are, and probably if you need constant medical care, you might need a specific kind of transportation. So if you didn't have a car, you might need to buy a car, or you might need to Uber, or or maybe you even have a car, but because you're unwell, you cannot drive. You might need to hire somebody else. And of course, some people get to a point where they need a caregiver or private nursing, and that is usually not covered. In Kenya, we don't have long-term care insurance. We don't have that. So private caregiving nursing is not insured. So you'd probably even want to use, or maybe to take your relative or to take yourself to go and enjoy the facilities of palliative care. And that does not come cheap. So it's important to have this in mind. But in addition to that, even when you have a medical insurance, it comes with limitations. There are exclusions, certain diseases that will not be covered, and especially new diseases that come up before the insurance industry is able to get data and to price the risk, those ones will not be covered. Insurance has limits. You'll probably be able to buy a certain limit, and within that limit, there'll be sub-limits for certain health conditions. The amount you need to copay, insurance companies sometimes will introduce copay, and especially for those who want to use the tier 1 hospitals, the Nairobi Hospital, Aga Khan, Mata, and sometimes Avenue. They say you need to copay a certain amount. That is not insured. Sometimes you'll choose not to insure dental and optical because it's not cost effective, or you probably don't think you'll need that service. But should you need it, then you'll have to pay it out of pockets. Access to services can be disrupted, as evidenced by sometimes insurance companies will have problems with certain providers, and providers will sometimes say they are not taking insurance from certain companies. So if you are unwell and that is the facility you need to use, then you'll struggle. You will need to have some money somewhere to take care of that. And sometimes you've been working with one provider and then they load your premium such that the cover becomes unaffordable because of loadings, or sometimes they decide that they will no longer provide that particular insurance. So they decide they will not provide, and then you'll have to actually move to another provider. And we saw all those issues we talked about, waiting periods, among other things. So during that period, you might be exposed and you have no cover. We've witnessed collapse of medical insurance providers, especially this year, Resolution Health. So people had to look for cover elsewhere. And if you don't have the money to do that, then you'll struggle. And sometimes, depending on where we might need special evacuation services, which our covers probably do not provide. So this is just building the case as to why we need to prepare not only the insurance premiums, but you also need to prepare a medical fund that we can actually use to ensure that you're able to take care of your healthcare costs. So these are dual costs. You need insurance because if you don't, the cost of hospitalization for just a few days can be quite expensive. So we are talking about insurance premium when you want to pay for NHIF, which is a prerequisite for all other insurances. We encourage everyone to take an inpatient cover. Sometimes you might choose to take an insured inpatient cover, and sometimes you might want to add an evacuation cover. So one of the companies that offer affordable evacuation covers are the AMREF. One of my friends the other day was telling us for a cover of 2,500 per year, they were able, they've been running that cover, and when their father had a stroke in Coast, they were actually able to evacuate him and bring him here in Nairobi. So you might need premiums to take care of this. Now, on the other hand, when it comes to building a medical fund, then there are various ways you can actually do that. You need some money in cash because, for example, if you choose not to insure your outpatient and you need to see a doctor, you need to pay cash. Another way you can do that is to ensure that the medical fund is part of your retirement benefits, and that can happen in two ways. Either you use part of your retirement savings to cover the medical expenses and premiums, or you have a separate post-retirement medical fund, which you're saving towards as you go along. But you can also have an array of investments, and we'll discuss them, that you can actually put your money into those investments and target that this money is basically to take care of medical expenses. And of course, there's a very big role of insurances. Many of us know about life insurance. And yes, life insurance is part of the insurances that you can use to create a medical fund, and we'll also discuss several others. Now, for those who are familiar with how I help them plan for their finances, I focus on goal-based investing. So goal-based investing is where you do your investments to meet a specific need rather than to maximize returns. So most people want to they want to invest where they'll make the most return. And if you don't tie that investment to a goal, what sometimes could happen is that you have this medical emergency, but the investment asset you picked so that you maximize your return will not give you that money when you need it to see a doctor. So there is a mismatch. You could be having a lot of money, but you don't have money to actually go see a doctor. So for me, I normally work with goal-based investing, and that is the approach I will take for the rest of this meeting. So this kind of investing normally focus on attaining your personal or your life goals. So you have a goal that you want to take your children to school, you want to have a retirement income of this amount of money. You can also have a goal that I want to provide for my medical expenses in retirement, and this is the target amount that you're going to do. So it's important that at every stage of life, you actually review your goals, because goals will normally change. The focus or the priority of your goals will change depending on the life stage you are. So of course, when people are just leaving school and starting out, they're very focused on setting up and establishing themselves, ensuring that they have a home, maybe a means of transport. And then when the children come, people tend to focus quite a lot on their education, and that does not cease until they finish school. But there also comes a time now when retirement becomes a primary focus. But the approach I want to encourage you here is that you cannot wait to plan for retirement until later, until you take care of other things. You have to start now. If you wait until later, you will have to pay to make those savings at a premium. You'll have to put in a lot of money to be able to provide the benefits that you want. So it's important that even as you go along the life stage, regardless of how old you are, even if you're in your 20s, you can actually do this and actually ensure that it will not be a big burden as you move forward. There's a poll on my screen, that's why. So we are going to look at this and we look at three categories. One of them is retirement benefits, how you can use your retirement benefits, how you can invest in various investment structures, and how you can also do insurances to ensure that you get the benefits that you want. So the key thing here is to ensure that you have a diversified funding plan, because if you rely on one funding, what will happen is that if something goes wrong, for example, if property was your main funding, and we know what happened during COVID, some people didn't have tenants for quite a while, then you would not be having that money. So this is going to be a diversified plan, and these are some of the products or sources of funds that you can have. So when it comes to retirement benefits, it's important to recognize that NSSF is part of that. And when you leave employment or you retire from employment, you're entitled to a refund of your accumulated savings. Now, that is the current policy, but we know that the government wants to change that to become a pension plan where you can only access a portion of it as a lump sum, and the balance provides an income. But for now, you can actually get a lump sum. So some of my clients who have who worked for a very long time and retired about 2-3 years ago, they had a fund of about, I think, 400,000. That is not little, neither is it a lot of money, but the contributions have since increased, and we know that there is a push to have those contributions increase. So this is likely to provide a good lump sum, but that is one source. For those who are in a pension, in a provident fund, that is a pension, a retirement benefit scheme that allows you to access all your benefits as a lump sum, that can be a source of creating a medical fund. Now, one of the things I would want to caution you against here is that the more money you access as a lump sum, the more tax you're likely to pay. So it's very, very important that you make the right choice. And sometimes, as we'll see later, it is important that you engage somebody who can advise you on what portion of your income you access, because depending on the structure of your benefits, some people have a lot of tax-free amount, and some people have a lot of already taxed amount. So if you access the taxed amount first, then you might save on taxes. But if you just access like a slash or a percentage of every fund, like some providers will do, you'll actually pay a lot of tax. So instead of paying tax, there's a way you can transfer that money to a medical fund. You're allowed to transfer up to 10% of your retirement funds at retirement to a product that will give you that kind of medical provision, and that will be transferred tax-free. Of course, some people will take their retirement benefits as annuities, and you can actually take an annuity specifically to cover your medical expenses in retirement. And we'll see that you can actually have two types of annuities when we come to talk about insurances. Some people use income drawdown, An income drawdown is a product that allows you to access your retirement savings while the balance remains invested. So this one can allow you, the good thing with it is that it's quite flexible. And when you don't need to access an income, for example, if you still have other incomes, then you can leave your money to grow, and that growth can actually help you later on. And in case you need to access lump sums, you can actually change how you access your money every year. So if you've been told you need to plan for surgery next year, then you can actually change how you access your money next year and request that you get a lump sum that would probably be able to help you with that. But there's also the post-retirement medical fund, and I know many trustees are working on amending the trust deeds to allow members to do this. So I would encourage you, if your scheme allows you to do a post-retirement medical fund, please sign up. And because this is a voluntary contribution, no one will force you to do this. But putting in 1,000 shillings, 2,000 shillings, with time it will build up and it will be quite a big fund. So most of us will understand this, and I think in an earlier webinar I had tried to focus a lot on that, but I'll now focus on insurances. How can you use insurance products in the market to help you fund your post-retirement medical fund? So many of us take life insurances, and I've talked to a number of clients, and they normally say one of the reasons why they like life insurances is because it forces them to save. Of course, we wish you'd be able to develop the discipline to save without being forced or compelled, but life insurance, also because of check-off facility and the tax benefit you get on the insurance premiums, it can be a good way of planning for post-retirement medical funds. So you can maybe make a small contribution every year over a long period of time, and then the maturity can actually now be transferred. Once it matures from the life insurance, you can actually use it specifically for medical expenses. Now, there are products we call deferred annuities. And this is basically an annuity you can buy with a lump sum. You have your $500,000, you go to an insurance company, you tell them, I want to invest this money for the next 15 years. And I mean, you will not be able to access it for 15 years, but after that, you'll be able to receive it as an income, and you can structure what frequency of income you want to receive. If you want to receive it on an annual basis, or twice a year, or every month, whatever frequency you can structure with insurance companies. Now, many of us along our careers, we normally get quite some good amount of money, especially in bonuses, and maybe we sell an asset somewhere, we get an inheritance. And you can actually use some of those lump sums when you're comfortable, when you won't even feel that pinch. You just take that amount, put it in a deferred annuity, forget about it, and at the back of your mind, you will know that you're taking care of your post-retirement medical fund. This being an insurance contract, it is basically a promise. What insurance promise they will pay, because you've already met your obligation. You've already paid the premium. So we call them paid-up policy. You pay all the premiums that need to be paid as a lump sum, and then you invest it until a certain at a certain age, and then from there you'll be able to access. So you can access that income in two ways. You can access it either for a specific period of time, mainly 5 years. And what that means is that you can actually build your post-retirement medical fund such that you have enough money to pay premiums, but you're also building the lump sum that you might need to pay for hospital bills, and then you transition it from insurance and you put it in a money market fund where it can be accessed later on. But it can also be structured to give you a premium for life, or rather an amount for life. So you can choose, for example, this is where your annual premiums for your inpatient cover will come from. Or you can even say, this is where my monthly medical expenses will come from. So for example, if you have a condition you have to manage, you can estimate how much you use per month, and you can structure it such that you know that your medical expenses will be met from this. So this would be probably in addition to an annuity that provides you with an income which you use for living expenses. Now, these are some of the products that are highly underutilized, yet they are the products that give you guaranteed returns. And also, they are highly protected because insurance companies put this in the life fund, and they have to ensure that that life fund is fully funded. And it's under the supervisory of actually insurance regulatory authority. So this will do much better sometimes actually in most cases, than even a post-retirement medical fund where you are saving and the return depends on how the economy is performing. So the only thing about this product is that during that time when you have deferred access, you cannot access that money, even if you lost your job. So by the time you do deferred annuities, we encourage you to have other liquid assets that you'd be able to utilize should you have that urgent need. Now, for those who retire early, maybe before age 60, and for all of us who are below age 60, a life insurance can provide you with a rider called critical illness. And some insurance companies are even providing this cover as a standalone. You don't have to have another life insurance to get this. Most employers cover, group life covers will normally have critical illness. And basically what this cover does is that they specify the specific conditions they cover. And these are conditions like heart attack, cancer, major organ transplant, paralysis, those critical conditions that normally affect your longevity, and they also affect how you're likely to live. So you'll probably need a lot of money to manage the conditions, or you'll even need to make lifestyle changes. You might need to start using mobility aids and all those kind of things. So this cover can continue providing you with that possibility that should you be diagnosed with any of those conditions, then this cover normally pays a lump sum. It's not on treatment, is you go to a doctor and they confirm you have this condition, one of the specified conditions, and they will pay that amount. So for employer benefits, normally this cover is quite huge. Some companies have a limit of 3 million, others 6 million, others 12 million. That is what they would actually pay the maximum limit, but it's normally pegged on your benefits. So it's a multiple of your salary. So if you know your family history and they probably have a history of certain conditions, then you're probably more predisposed to getting some of these conditions. And you can actually take an insurance so that should this happen before your age 60, you would benefit from this. And this benefit will normally be paid whether you have a medical cover or not. However, because most critical illnesses will become very prevalent after age 60, insurance companies will not provide this. Most of them do not provide this cover beyond age 60. But while at it, you will be able to get that benefit should you be unfortunate to get it. You can also take what we call life insurance or whole life insurance. And what happens with life insurance, pure life insurance only pays on death. Now, the reason I put this one here is because sometimes one of the spouses will normally get sick and utilize the family resources. Maybe they exhaust all the insurance, then they start using the family resources. And by the time probably they pass on, they leave the family without resources. So where you have a life insurance, what it would ensure is that upon your death, then you'd provide something for your family. So it will go to replenish some of the resources that you have actually utilized. Now, pure life insurance, an insurance that has no savings component, is normally quite cheap. You cannot compare it with the life or education policies that we normally take. So I would encourage people to take this life insurance, especially when they're young. When you are young, the premium will be very little and they normally don't change. I mean, once the premium is determined, it doesn't change as you age. But if you come in later and take the life insurance, of course, it is still much cheaper than the endowments and the ones that have savings components. But of course, the premium will be a little bit higher. So we are talking, I recently took a term assurance and which has even other riders. And I took a cover of 5 million. And my monthly premium, I'm turning 46 years old, and my premium is just below 5,000 shillings per month. Now, if I was in my 30s, probably I would be paying 3,000 or 3,500 per month. And that is for a cover of 5 million in the event of death due to an illness. It will pay 10 million in the event of death due to an accident. And it will pay 5 million in the event of permanent and total disability and a critical illness of 2.5 million. So I'll get all that benefits for a premium of less than 5,000 shillings. So these covers are not expensive. And that is not even a pure life. It has other benefits. So if I was only taking a death benefit, which would only pay in the event of death, it would definitely be much, much cheaper. So consider taking this. Most people will normally have this covered. They have a group life with the employer and a group personal accident with the employer. But it's important to know that the minute you leave employment, you no longer have that coverage. So since no one knows when they will pass away, then it would be important to maintain that, to ensure that should you utilize your family's resources, you will have something left for your families. Investments. So in the investments arena, I think this is where most of us know and have an interest. There are many products and there are many investments that you can put in. And like I said, where you make an investment with a goal in mind. And we tend to do this quite well when it comes to educating our children. Most people will have solid plans and they say, this investment, I'm doing it, and the purpose is to educate my children. And I wish we can just use the same mentality and the same plans to actually do the same for retirement income and medical in retirement. Because people will buy a piece of land, or they will buy an insurance policy with educating the children in mind. You can buy a policy, a life insurance policy, to provide for medical expenses for your family, or when it matures, to actually be converted into another asset that is liquid and you can use it. So it is possible to do this, but one of the products you will need, regardless of how you plan for your retirement, post-retirement medical, is a money market fund. Because a money market fund is basically an account that you can easily access your money should you need it, but it's a bit far removed from you because you can't use your ATM card. So you'll need to apply for a withdrawal, whether it's through an app or writing an email to the provider. So, and the good thing with a money market fund, in contrast to a bank account, is that it will be earning an interest. So this is where you keep your outpatient money. This is where you keep the money that you need to constantly take care of medical expenses or chronic conditions. And even just having that money, should there be need, the older you get, the likelihood of falling ill increases. So you have this money such that should you get unwell, then you can actually utilize it. A money market right now, they've been doing quite well. We are in an era where the interest rates are doing quite well. So many providers will provide a rate between 8 and 9% per annum. So this can be a good investment because your money is trying to beat inflation, but again, it is also easily accessible. And you can use other unit trusts. Money market is just one of the many unit trusts. You can use other unit trusts, especially you can use the bond fund or the income fund. They mainly invest in bonds. I would caution you against putting your money in a growth fund or an equity fund, because as the prices of equities go up and down, you are likely to lose part of the value, and probably you might be forced to liquidate your units when the values are down. You can use mainly the bond fund and the money market fund. But the other investment, again, that is so good with medical expenses is bonds. Now, bonds are normally issued by the government, what we call treasury bonds, or companies. We call them corporate bonds. And sometimes we've seen the county governments now, they're issuing them. So sometimes they're issued by the local governments. But in Kenya, the treasury bonds are issued every year, and they have been posting some of the very good returns. And the good thing about it is that, yes, debt is not a good thing, but having the government as the person who owes you money, they are probably the most risk-free debtor. Because a company can go out of business, but before a government is unable to repay its debt, then things would really, really be thick. I don't think anything else would be working. So bonds are safe and they have very good returns. We've seen a lot of infrastructure bonds being sold this year with returns of about 12.75 and above, 13 point something. And you can actually have several bonds. You structure them, and that's what we call bond ladder. You structure them such that the interest comes almost on a monthly basis. So a bond will pay interest in 2 months a year. That is, let's say you buy a bond in December, the first interest will come in June and the other one will come in December. So you can buy another bond that will pay interest in the other month, such that you actually have a parallel income. And this is, bonds is one of the investments that we should all get into. And it is one way of creating passive income. So as you start your careers and as you build your careers, your income is growing, but the biggest risk you have is that you might lose that income. So one of the ways we need to do is to actually invest in bonds so that we start building a parallel income. Now, many of us don't have bond investments. And yesterday I had a client who works in the bank, and I asked her one question: which is the most profitable industry in Kenya at the moment? Her first answer was telecoms. I mean, because of Safaricom. But I told her, no, Safaricom makes a lot of money, but all the other providers make losses. So it's sort of a net, they don't make much money. But look at the banking industry. They've been posting very, very good results. When you look at where they invest their money, they have a lot of their assets in government securities. I think because of their performance, we can borrow a leaf from them. For those of us who are members of retirement benefit schemes, the schemes that are posting good returns, when during the AGM, they normally say where they invest their money. You'll find that most schemes are investing 40 to 70% of their funds in bonds. Let's borrow a leaf from those professional investors and let us put our money in bonds. So bonds will give you a good return. It is completely passive. You don't have to do anything. You actually get money in your account on the day the government promises. And in addition to that, it is very easy to sell a bond. You can sell your bond within days. So should you need that money to cover medical expenses, you will be able to do that. And then the fact that they are giving you an income, that income can actually either pay for your insurance premiums or pay for your medical bills. Some people enjoy putting their money in fixed deposit accounts, and if you have a sizable amount, you can actually take the interests on an annual basis and use it to pay your premiums. Rental property, I think many of us will probably be looking at property as the area where we will make that regular income. It is a source of income to pay premiums and also to pay for your medical expenses. But it's important to note that this source of income is not guaranteed, unlike the others we have spoken about. Because if you don't have a tenant in that particular month, then you will not have the income. But it is part of the investments that you can make. And sometimes we need to sell assets to build our medical funds. Sometimes we have accumulated a lot of things in our homes, but we don't need them. It would be important to actually evaluate and see what are some of those things that I can sell. So do I need to sell some of my assets like shares? Many of us have an assortment of properties everywhere. We are still holding on to them. Some of us want to pass them to the next generation, and they may not even be interested in them. So you'd rather sell these assets, take care of your medical expenses, as opposed to passing assets that don't even benefit the beneficiaries, while you end up requiring their help. So it's a misnomer there. It doesn't look good. The children would rather you take care of your medical expenses instead of leaving them assets they might not want and them having to contribute to your medical expenses. And as you move into retirement, I think this becomes quite necessary. Many people downsize. So you might want to move from your urban home to go to a rural home or something like that, or to even a smaller house because your children are all grown and they've left the nest. You might realize that you don't need 2 cars anymore. So you can actually sell 1 car and put the money into a medical fund. So there's so much you can do, but these are just asset classes or investment assets that you can actually consider. And I'll just want to use an example, a case study. As I said at the introduction, I looked at my clientele and just looked at what are the kind of assets that they've had. Now, it's good to mention that a significant portion of my clients are professionals who are employed. So these are people who are spending most of their time in the workplaces. They mainly don't do a lot of business. They mainly don't do a lot of side hustles, but they tend to have investments in financial services. So for example, my clients, what I'll notice is that they'll tend to have a home. They'll have a home, whether it's on mortgage or it's fully paid up.
You guys are not seeing eye to eye. And you're required to go
there's someone who we need to mute.
And that's the conversation that's not just marriage isn't a walk in the park, but you can't.
Ava, you can help us to mute.
We are okay now.
So many people will tend to have, because they're in employment, will tend to have either a pension scheme or a gratuity, but there are also some organizations that will give you the money to take care of your pension, and some people don't actually put that money in a pension plan. But on average, many clients will have a pension, they'll have a home, and they'll probably have another home maybe here in Nairobi, where they live, or they've rented it out. Of course, they have vehicles. Many will have life insurances. Few have money market accounts, not everyone. But this is typical of people in employment. And so how can we optimize these resources for somebody who has this structure of investments to enable them live a good life in retirement, and of course, ensure that they take care of their medical expenses. Now, when you do financial planning, we do customized financial plans. We do a financial plan per client because their circumstances are very unique. So when I'm making this plan here, what I want you to know is that I have made very, very many assumptions. So this might not work exactly for you, but this is just a guideline on how we can structure some of these investments to ensure that they take care of their medical in retirement. So I've tried to look at sources of funds and what you could do with some of that money. So for example, you could sell an asset. Many people will tend to have SACCO savings at retirement. We encourage people to pay off their debts way before retirement. You could have an insurance maturity that is coming up, and like I mentioned, NSSF normally pays you a lump sum. Now, I would encourage everyone who can foresee that they are likely to work until retirement age, or who have a target retirement age. You can make some of these arrangements about 5 years before, so that they're already in place by the time you retire. So an example would be, this client would take, for example, some 2 million, which could come from either the SACCO savings, if they can leave the SACCO early if they want to, or they can sell some assets. Especially many people have an assortment of pieces of land all over. You can take your time, at the right time you sell, and then you can use that lump sum to actually buy a deferred annuity. So deferred annuities, when you're taking one, you have to get a quotation from the insurance company, because the rates vary from almost day to day, depending on where they're investing. So if you bought a deferred annuity, and the assumption here is that somebody's retiring at 60. If you took a deferred annuity, probably at age 55, the value is 2 million, and you want this annuity to pay an income for life, but this income will start coming at age 60, this can actually earn you 33,000 shillings for the rest of your life, regardless of how long you live. Whether you live to be 90, 100, you'll get your 33,000 shillings. Now, the other thing that you can do here, you can actually opt to start lower, and then your monthly income increases from year to year. So it can start maybe at 25, then next year it grows by 3% or 5%, whatever escalation that you pick. But you can actually decide that for my medical expenses, I'll buy this deferred annuity. Deferring it makes the money grow. That is why we encourage people to start early. But if you don't have that money before, you can still use part of your retirement benefit savings or the maturities and just buy a deferred annuity, an annuity, and start receiving the income. You could also take a deferred annuity with 1 million shillings with the purpose of building a cash fund that could be used in events of hospitalization, and maybe either the condition was not covered or you burst your cover limits. So what is required is basically a lump sum amount. So again, I encourage people to start early, so that by the time the deferred annuity starts paying an income, you'll be able to have some lump sum. And for this one, I normally encourage people to access the money as an annual amount as opposed to a monthly amount. because you'll be able to access 345,000 upfront, and then you can put it in a money market account. And the calculation I did here, if you want to have an income period, that is, if you want this deferred annuity to pay you an income for 5 years, then you'll start at 345,000 per annum. And the quotation I used is one that escalates that amount by 5% year on year. So the first year you get 345,000, probably your premium is 100,000. So you have some 245,000, which can take care of any expense that might come. Then the next year, that 345,000 grows by 5%, and it will continue growing until the end of the period. Or you can choose to have an extended income period, and it can go for 10 years or even more than 10 years. So you can actually have both, a deferred annuity that pays an income every month and a deferred annuity that pays an annual lump sum that will help you to build a fund. You can also buy a bond, and a bond, I used an example, I think, of one of the infrastructure bonds that were issued this year at a rate of about 13%. If you target an infrastructure bond, you don't pay tax on interest, but sometimes you might not get an infrastructure bond. You can still buy another bond, a long-term bond, and get to pay a withholding tax of 10% on interest. So this bond would give you 130,000 shillings every 6 months. So you can probably use your 130,000 to pay your annual premiums for inpatient cover. And then you can start building an outpatient fund with the other amount. And then you'll be able to meet your outpatient expenses out of that interest. Some people use fixed deposit accounts. On average, some good banks will give you an interest rate now of 7%, but this will keep fluctuating depending on how the markets are. And that can give you an annual interest of 159. So the capital remains invested, but you have 159,000, which you can actually use to pay your annual premiums. So that is just an illustration of what you can use one, or you can use all of them. You can use your pension savings. And you can decide that I'm going to put my money in an income drawdown, or I'm going to put it in an annuity. For those who are in pension schemes, you have to put it in either of those two. You can access a third of it. So in this case, I assumed this person accessed the 5 million and they used 10 million to buy an income for life, or they put it in an income drawdown. And so this 100,000 will probably be to cover your living expenses. But you can use part of the money. For example, you can take out of the 500,000, of course, probably there'll be some tax payable. You can pick a fund now to do what we have discussed up here, or you can put it in a money market fund where now you can be paying your outpatient expenses out of there. Or should you need to top up for a medical bill, you can actually get it out of there. And of course, if you have been saving in a post-retirement medical fund, then that is quite flexible. There are various ways you can use it. One way is to actually transfer to an already product. There are products in the market now where you can actually, they can calculate how much premium you need to put in and to provide you with a cover for life. So you can decide to transfer your money to such a provider. And of course, it has limits, and decide, I've taken care of that, but you can also build a fund just in case the cover limits are exhausted. Or you can maintain the fund, and the fund can remain invested, and then you can be paying your expenses out of that fund. So every year you can collect your annual premium for inpatient cover from there, and every year you can decide, okay, I need this fund for outpatient, or you can pay the expenses and request them to reimburse, or they can even sometimes pay directly to the provider. So there's no limitation to that. It's quite a flexible product, and you can use, like I said, you can create that post-retirement medical fund, or you can actually transfer 10% of your accumulated savings before you access them, and you push them in the post-retirement medical fund. And of course, for those who are in property, you can accumulate your rental income in a money market fund, and you'll be able to take care of your annual premiums, and you'll also be able to take care of your out-of-pocket expenses. So this is just a very simplified way of doing it. But as we are making this, we make these recommendations, we normally look at what else you're dealing with. Do you have children in school? Do you have other obligations? Do you have dependents? Are you taking care of your parents as you take care of your children? Are you taking care of other people? What are the cash flows expected? How much are you expecting in? How much are you expected to pay out? Amongst other things. So this will not work for everyone. Some people will use deferred annuities for. Other people will not use deferred annuities because they need more liquid investments. Others, we can use a combination of this, and others probably they're interested in something else, will actually go with that. So we also look at your personal preferences, but we try to ensure that we can actually provide for that. So that is an example of some of the products that you can use. But I also want us to look at other reasons why we need to prepare. So initially I said we need to prepare because we will live long, we are retiring early, we have inflation amongst other things. But that is not just why we prepare for life in retirement. And I think many of you have heard me say that that is a second half, that is another life that you could start. And we have very many examples, even in the world, of people who did so well in their later years. But for you to make sure that you have a meaningful life, then you must be able to take care of your living expenses, you must be able to take care of your responsibilities, you must be able to take care of your health. So once you do that, then we need to plan for these expenses, knowing very well that we have another season of life and we would want to be effective. So once you take care of the finances, they are no longer a concern, then you can actually use your time in retirement to pursue things that you're passionate about, things that you're effective in, you contribute to society in whichever way, whether it's setting up businesses, whether it's mentoring others, whether it's starting a totally new career, and you can actually focus on doing things that energize you. So you won't do something because of money, but you'll do something because you're fully equipped and you enjoy doing it, such that your second half of life can actually be better than the first one. So it's not just so that we're able to take care of our medical expenses and then we coast through retirement. For those who are Christians, we know the Bible does not have the concept of retirement, but we are actually expected to use our strengths, which by now we have become very aware of, to pursue passions and to use the excess resources that we have, such as time, money, or even knowledge and skills, and even spiritual knowledge. You've gone through experiences, you've experienced God in very many ways. You can actually share that excess capacity with other people. And of course, you get to choose the context in which you apply this, whether you are going to start a new organization, whether you are going to continue with the kind of business that you are doing. You can actually choose where to do this. And when you do that, then your second part of life, or your second half, will be meaningful. And you'll not just be feeling old and not useful, as quite a number of people actually complain about. So there are a few words of wisdom we normally get from scripture, which I would just want to remind you of some, especially some two scriptures in Proverbs. One talks about the ants. It tells the ants, tells us to go observe the ants and consider its ways and be wise. Without a chief or someone to manage them, they normally prepare its food in summer, and it gathers its whatever it will need for winter. Now in life, when you're doing well, when you're young and you're making money, that is your summer. But what you know about life is that the winter season always comes. Life is full of seasons. So you're working and you know there'll come a time when you'll not be able to generate that income. So be wise like the ants. They actually store their food in summer so that they can have food in winter. But I would also encourage you that it's important to seek counsel, to seek help from people who can help you. As you have seen, though, that combination, and as I have said, it's normally not a rule of thumb that this is what you do. It depends on very, very many circumstances. So when I'm sick, I go look for a doctor. When I am not able to figure out things, I go to a coach or to a counselor. It's important to engage people who can help you to make these decisions. So look for a financial planner. Proverbs 15:22 tells us plans go wrong for lack of advice. And I think we can attest to that, especially with finances. But with many advisors, there is success. So if you get a professional who can guide you on this, you might be able to make much better decisions. So you might feel like, okay, fine, now I'm in retirement or I'm approaching retirement and I never did these things. So what do I do? I would encourage you to start where you can. One of the things that we need to continue with in life is to continue saving for the later days. So if you don't have the savings, then out of the lifestyle that you're living, you need to just make sure that you're putting aside something small so that should you fall ill later, then you'll be able to take care of that, or so that you can be able to afford insurance. But it is important to recognize that even when we make these preparations, it is very important that we make them because God has given us the resources and He has given us the knowledge to do it. It's important to know that God will always be with us. So our hope and trust will not be in these resources that we set, but we will actually trust in God because He promises us. I think the only book verse we know very well about retirement, Isaiah 46:4 says, even to your old age and gray hairs, I am He. And I will sustain you. I made you, I will carry you. So let us not lose hope. Let us also look to God to guide us on what we need to do. But let us use the knowledge and the wisdom that He has given us to actually make the right plans. Because even as He rescues us, we'll probably have struggled with stress and concern before He comes to our rescue. But when we make the plans, then again, we remember that our trust is not in the resources that we have set aside, but remains in God. So if you feel like you need help to organize your finances and to structure your assets to enable you to prepare for medical in retirement, I normally run a 6 weeks program. This is a one-on-one approach. I either deal with you as an individual or with your spouse. And in those 6 weeks, the first week I get to know you, I get to find out where you are in life and how your investments are. We analyze your financial position and we see what is going on well, what is not okay. We set and clarify the goals and prioritize them. And then on the 4th session, I give you strategies to meet them. And I also teach you a decision-making process, how you can make decisions that will normally meet your most prioritized objectives. And of course, after that, we normally look at work as a main source of income, but also thinking beyond the jobs that we do and looking at how we can be impactful and live a life on purpose. So if you would be interested, please give us a call. If you've not gotten a copy of my book, I encourage you to get one. You can get it directly from me, or you can get it from any of these bookshops. And should you need to get in touch with us, you can reach us through the email that sent the invitation to you, or you can actually call us. So thank you very much for listening. I hope you've been able to glean something. I hope, I hope you'll be able to apply what we have said. And like we said, if you need help, please seek help from a professional financial planner, an investment advisor, and somebody who is keen on meeting your need, not selling you a specific product that might be basically benefiting them. So yeah, and that brings me to the end of my presentation.
Thank you very much, Rose. That was insightful. So let me start by sharing the results from our poll, and you can comment on these results. In the meantime, if you have any questions, just leave on the chat.
So 63% of those in attendance are people in employment. Like I mentioned, basically, I know most of the people who attend are in employment, and about 20% are in self-employment, and 13% are retired. Yeah, so basically about 80% of those in attendance are still generating an income. So you can actually consider taking up some of those investments. For those who are retired, you probably have already made some of these decisions, but there is always room, especially if you're generating an income, there's always room to structure other investments to ensure that you're able to take care of these medical expenses in retirement. Right, thank you.
Thank you. Those asking whether you're going to share the slides, yes, you can do so. to your email tomorrow, and also the recording. I'm not seeing any questions, just very many compliments. Thank you, Rose, for the presentation. It was very insightful, very informative. So thank you very much, Rose.
I think, Regina, I would want to make one comment. I've talked about the cash option. When people are accessing retirement benefits, the cash option normally appears very, very tempting. And it is true. Many people, when they have an option of accessing their money as a lump sum, they tend to do so. And they assume that they will make very, very good decisions. But what we have seen over time is that many people are not, they are not able to make decisions that ensure that they stretch that money as long as possible. And when we meet retirees, especially those who chose to take less money as an income, many of them regret that decision. So it's important, especially when you are making a decision about accessing your retirement benefits. I would say, even if you just need to consult for that one meeting, it might cost you 5,000, it might cost you 3,000. I would encourage you to engage someone who can basically paint for you a picture of what would that mean in terms of alternatives. People tend to know what they will do with the money, and they make very optimistic assumptions that business will go well, everything will go well. But probably when you get a comprehensive picture, you might be able to make a much better decision. So yes, it is tempting, but most temptations do not lead to good things. So let's not fall into temptation, but let's analyze our situation and actually make the right decision for us, because this is one of those decisions where once you make it, you cannot reverse it. It is done once and for all. And once you access your money, you've paid taxes, there's no way of recovering that. And taking it back to the insurance company to give you an income, for some, it is very hard to do. But yes, it is true. It is a very tempting decision. It is okay for some people to take lump sums, but in most cases, it is not okay for majority of us to take our retirement benefits as a lump sum. Thank you, Mary.
Okay, thank you for that answer. There's a question from Caroline. Tell us about annuity. How does one work backward to know how much to receive monthly or annually?
Okay. So for annuities, what we do is that you have to get a quotation from an insurance company. So if you don't have the money, you can write to us. We'll just do a quotation. We'll assume probably you have 1 million. And then from 1 million, we can be able to gauge. So the insurance company will use your age, will use your gender. It will use the amount of money that you want to invest. And it will also look at whether you want to take this insurance with your spouse or with just as an individual. So I probably missed to talk about this. So you can take these annuity products, whether for pension income or for medical expenses, together with your spouse, so that whoever dies first, then we leave something for the other spouse. The arrangement will continue. So if you're taking a joint annuity, that also will affect how much you're going to receive. So and it will also depend on whether you're taking an annuity that starts paying immediately or you're deferring, investing it for some years before you start getting an income. So insurance company will give you those figures. They'll tell you for 1 million, this is what we will provide for you at this moment. And then you'll be able to see whether that income is adequate for what you want to achieve with it. If not, then it means you'll need to improve on the amount that you invest. But yes, those rates keep on changing, and they normally give a quotation that is valid for a specific number of days, in most cases between 30 and 60 days. What is the minimum term for a deferred annuity?